How George Soros made $1 billion in one trade, a trading history lesson. Introduction. Imagine making $1 billion from a single trade, not from building a company, not from winning the lottery, but from understanding how an entire country's currency was about to collapse. It sounds unbelievable, but that's exactly what happened in 1992 when George Soros made one of the most famous trades in financial history. The trade was so significant that it earned him the nickname, the man who broke the Bank of England. Today we're going to explore the incredible story behind this trade, what happened on Black Wednesday, and most importantly, what modern traders can learn from it. This video is for educational purposes only and should not be considered financial advice. Let's begin. Chapter 1. Who was George Soros? Before we discuss the trade, let's understand the man behind it. George Soros was born in Hungary in 1930. After World War II, he moved to England and later to the United States. Over time, he became one of the most successful investors in the world. Soros founded the Quantum Fund, a hedge fund that generated remarkable returns for decades. Unlike many traders who focused on charts alone, Soros specialized in understanding economies, governments, interest rates, and global financial trends. He was known as a macro trader. This means he looked at the big picture. Instead of asking, "What will this stock do tomorrow?" he asked, "What is happening to entire economies?" This approach would eventually lead him to one of the greatest trading opportunities in history. Chapter 2. The problem with the British pound. To understand the trade, we need to travel back to the early 1990s. At that time, the United Kingdom was part of a system called the European Exchange Rate Mechanism, often known as the ERM. The goal was to keep European currencies relatively stable against one another. This meant governments had to maintain their currency within specific limits. The British pound was tied to this system. However, there was a problem. Britain's economy was struggling, economic growth was weak, inflation was creating challenges, and many experts believed the pound was worth more than it should have been. In simple terms, the market believed the British pound was overpriced, but the government continued trying to keep it strong. This created a dangerous situation. Chapter 3. Soros spots the opportunity. While many investors followed the crowd, George Soros saw something different. He believed the British government would eventually fail to defend the pound. His reasoning was based on economics. The Bank of England was spending enormous amounts of money trying to support the currency. Interest rates were being manipulated, yet the economic fundamentals continued to weaken. Soros believed this situation was unsustainable. Eventually, reality would win, and when it did, the pound would fall sharply. This was the opportunity he had been waiting for. Chapter 4. Building the trade. Now came the difficult part. Having an idea is one thing, acting on it is another. George Soros began building a massive position against the British pound. In trading terms, he was shorting the currency. Shorting means betting that an asset will decrease in value. If the pound fell, Soros would profit. If the pound remained strong, he could lose enormous amounts of money. This was not a small trade. Reports suggest Soros and his fund built positions worth billions of dollars. Many people thought he was taking an enormous risk, but Soros believed the odds were in his favor. He wasn't gambling. He was making a calculated decision based on economic evidence. Chapter 5. The tension builds. As pressure increased, the British government fought harder to defend its currency. The Bank of England spent billions purchasing pounds in an attempt to maintain its value. Interest rates were raised. Government officials made public statements. They wanted investors to believe everything was under control. But markets are powerful, and markets often recognize problems before governments do. Investors around the world began losing confidence in the pound. Selling pressure increased. The battle between the market and the government had begun. Chapter 6. Black Wednesday. Then came September 16, 1992, a day that would become known as Black Wednesday. The Bank of England continued spending huge amounts of money trying to support the pound, but it wasn't enough. Investors kept selling. Pressure continued to build. Eventually, the British government made a historic decision. It withdrew the pound from the exchange rate mechanism. The pound immediately fell in value, the market had won, and George Soros had been right. The trade he had prepared for months was finally paying off. 7. The billion-dollar profit. As the pound collapsed, Soros's position became incredibly profitable. Reports estimate that his fund earned approximately $1 billion from the trade. $1 billion from a single idea, a single analysis, a single opportunity. The trade instantly became legendary. Financial newspapers around the world covered the story. Investors studied it, traders discussed it, and George Soros became one of the most famous investors in history. But the most important lesson isn't the amount of money he made. The lesson is how he identified the opportunity. Chapter 8. Why the trade worked. Many people assume Soros became successful because he was lucky, but luck alone doesn't create trades like this. Several factors contributed to his success. First, he understood economics. Second, he focused on facts rather than opinions. Third, he was willing to challenge conventional thinking. And fourth, he acted when he saw a clear opportunity. He understood something many traders forget. Markets eventually move toward reality. When prices become disconnected from economic fundamentals, corrections often follow. This principle remains relevant today. Chapter 9. Lessons for modern traders. So what can traders learn from George Soros? Lesson number 1. Think independently. Don't blindly follow the crowd. Lesson number 2. Understand the bigger picture. Markets are influenced by economics, politics, interest rates, and investor psychology. Lesson number 3. Patience matters. Soros did not rush into the trade. He waited for the right conditions. Lesson number 4. Risk management is essential. Even great investors prepare for the possibility of being wrong. And lesson number 5. Continuous learning is crucial. The financial world changes constantly. Successful traders remain students forever. Chapter 10. The most important lesson. Many people focus on the $1 billion, but that isn't the most valuable part of the story. The real lesson is that George Soros developed a process. He studied, he analyzed, he questioned assumptions, and he acted when evidence supported his conclusions. Success in trading rarely comes from one magical strategy. It comes from discipline. It comes from preparation, and it comes from making rational decisions when others are driven by emotion. Conclusion. The story of George Soros and Black Wednesday remains one of the greatest financial stories ever told. A trader looked at the market. He saw a problem others ignored. He trusted his analysis, and when the moment arrived, he acted. The result was one of the most famous trades in history. Whether you're interested in Forex, stocks, crypto, or investing, the lessons remain the same. Think independently, manage risk carefully, stay patient, keep learning. And remember, the goal is not to find a billion-dollar trade. The goal is to become a better decision maker, because great decisions, repeated consistently over time, are what create long-term success. Thank you for watching.